It's not in the face! Thank you.
Hello and welcome to Hey, Not the Face with your host, John Nash, and your producer, me, Steffi Haynes. And today, we are going to look at a special report from Guy Davis, who is a forensic accountant and the one assigned to the antitrust lawsuit by the plaintiffs. John, how the hell are you?
Good. Had a busy weekend. Had a lot of reading material dropped on my lap this last week. So
yeah, there are a lot of pages here, and just right off the top, as you are reading through this document, once you get past all of Mr. Davis's credentials, which include 28 years of being a forensic accountant, and lots of cases that he has handled in courts. But anyways, one of the first things that flew out at me was purchases made by Zuffa. This is on page 12 of 73, section C, titled Factual Background, History of Zuffa, LLC, and the UFC, and item number 13. Would you please read that and explain?
Okay, well, beginning in 2006, Zuffa purchased several MMA organizations, including World Extreme Cage Fighting, WEC, World Fighting Alliance, WFA, Pride Fighting Championship, Affliction, and Strikeforce Mixed Martial Arts.
Affliction. Back up, please. Affliction. Now, I want to focus on that for just a second because most people not named John Nash are under the impression that Affliction folded and that all those contracts sort of evaporated into thin air because Affliction folded. And we were all led to believe that Affliction folded solely because of Josh Barnett. But there are extenuating circumstances, are there not?
Well, yeah. I mean, actually, thanks to the antitrust lawsuit, we know one is that Affliction was actually in contact with Zuffa back in 2008. People that go back that long enough, they know 2008 in I think July or August 2008, there was the Fedor Emelianenko versus Tim Sylvia Affliction ban fight. Shortly thereafter, Affliction got in contact with the UFC about the UFC acquiring the assets, taking over the event for Affliction, and running it. Now, nothing really became of that. But then later, Affliction ran into trouble with the third bout, the trilogy bout, they're calling it, when Emelianenko was going to take on Barnett, and Barnett failed his drug test. And they had contacted, they tried to rescue it, I guess, the event, but instead they were giving up, and they contacted the UFC of taking over the event, basically paying everybody's salaries, and then owning the event, and Affliction would exit the MMA business. That didn't quite happen. So what they did is they folded the event. They just killed the event, declared their losses, and then sold the assets that they had, which included some fighter contracts that could be transferable, as well as the rights to the video, the film rights and stuff like that, to the UFC.
So for all intents and purposes, Zuffa bought Affliction, which is why it's in this particular item number here among their purchases.
Yeah, Affliction, we should be clear, Affliction MMA. There's also the Affliction, the clothing brand. They didn't buy that, but they bought the Affliction MMA promotion. They bought the assets for that.
Wow. I do believe that most people don't realize that's what happened. World Fighting Alliance, WFA, there's something special going on there. What is it?
They bought World Fighting Alliance, which is kind of interesting, is later in this document. This is the Guy Davis report. It's he's a CPA accountant, or his list of credentials that covers several pages. He was hired to look through Zuffa's finances. So the information we got here is him compiling both public reports, Zuffa filings to the government, basically for tax purposes, as well as their own internal finances and other reports. He compiled them all to probably the best financial picture you'll find anywhere that we, not a member of, not the Fertittas or Dana White, can get for this period. He was hired for that. And one of the things that's interesting is they they had a bunch of acquisitions and promotions. And Zuffa had a note from that. They did a document called the Intangible Asset Memo in 2007 that they Zuffa wrote up. At least Zuffa supposedly wrote it up, right? I think there's no signature to it, but all evidence is Zuffa wrote it up, or Zuffa had it written up for him, one of the two. And what it said is that what's interesting is it talks about the reasoning why Zuffa acquired this little-known WFA. And it even says, the purpose of Zuffa's acquisition of the small and little-known WFA was a defensive strategy to eliminate a second-tier competitive brand operating in the Las Vegas market. The company believes that it is appropriate that the entire WFA purchase price, including the portion not specified in the purchase agreement as a non-compete component, be classified as non-compete assets and amortized over a period of 7 years. Okay. So the whole point is they had bought this. They wanted it included as the non-compete. Basically, they purchased it solely to get a competitor out of the way, even though they classified as a second tier. And if people remember a lot of stories, SureDog was writing about at the time. I guess we go Jeff Sherwood, Josh Gross, Greg Savage, those guys talking about. There were a lot of rumors at the time that UFC was very protective of the Las Vegas market. Remember, they supposedly were working behind the scenes to try to block or hamper Pride's ability to put on shows there. The WFA here, other promotions supposedly had problems. So this is probably some evidence, and it for the plaintiffs, it's good evidence because it shows a plan by the UFC to protect this market, which is good for them and probably bad for the defendants. I don't know how much in totality something about event from 2007 is going to enter the case, but it plays a part. But it's interesting that that's the reasoning behind it. And you add in, we don't have in this document, but there's another email that basically they say the same thing about Pride, that they were going to buy Pride for the sole purpose, basically to keep someone else from getting it.
Amazing. Now, in this same section, the very next item tells how much their annual revenue increased between 2006 and 2016. Would you read from that and explain it, please?
Well, they bring up that they had a massive increase in revenue between this period, because this is the period they cover. 2005 to 2016 is the period this document covers. And they talk about annual revenues increased. At 2016, that year, they generated $703 million in revenue. That's a compound annual growth rate of 14.6%. So they went in fact, we know from 2005, the revenue was about 48 million. So from 2006, which was 180 million, it grew up to 703 million. During that same period, they have an EBITDA margin, or not a margin, but EBITDA, the earnings before interest, taxation, depreciation, amortization, that ranged anywhere from 38 million to 202 million per year. So the company was very profitable during those 10 years. And as we'll see later, if you get further ahead, I'm not going to jump, you get further ahead, you'll start seeing just how profitable, just how much of an ATM machine this company was for the owners. And the owners being majority, for most of it, the owners were exclusively Dana White and, of course, the Fertitta brothers, who owned the vast majority of it. But then later, in another group, a little hint, another group enters the picture a little bit later.
All right, John. So we are going to get into the next section, which is E, historical sources of capital.
Yes. Well, in this section, Guy Davis and his team, they go over Zuffa's three main sources of capital up until the sale to William Morris, WME, now Endeavor, right? And those are: one, cash flow from operations earned each year, or EBITDA. In other words, the money made from the business itself, right? So earnings before interest, taxation, depreciation, and amortization is EBITDA. So the money they make from cash flow from operations, that money that they can use either for working capital, to like invest it to build buildings, stuff like that, buy equipment, that's working capital, but they can also use that money to pay the taxes, pay interest on loans, and most importantly here, pay the owners. So that's one source of historical capital. The other one is debt proceeds from third-party lenders, because the UFC, as everybody knows their history, they took out a lot of loans. That's what that's from. And C, proceeds from January Capital Investment, which was one, Flash Entertainment. You remember them? Bought 10% of the promotion back in 2009. So that's the three main sources that money capital came into the company.
So, John, when you're looking through this tiny little section here, What stands out to you most?
I guess the number one thing is just basically how much money that the cash from operations brought in and they used for themselves, right? Because we have cash from operations, they brought in, basically Zuffa generated $1.25 billion, right?
Mm-hmm.
From 2005 to 2016. And then on top of that, they also took out a tremendous amount of debt financing. And that debt, not as much as money they brought in, obviously the revenue they generated, but they brought in, their term debt was $1.415 billion in term debt. Now there's loans they took in. Now a good portion of that was refinancing. They had loans, they had to take more loans to pay the old loans off, that sort of thing. But a big part of it too, and it's very interesting, is in the early days in 2007 and 2009, they took two big loans out. First in 2007, they took $350 million total out. In 2009, they took another $100 million. The vast bulk of that money didn't go to operations, didn't go to anything else, went to paying directly to the owners. They distributed the equity, $320 million total from that. $450 million went to the owners as distributions. And that was probably the most eye-catching thing. And then just to cap it off, the final thing, they also got a bunch of money when January Capital bought 10% because they gave the previous owners $175.5 million for their 10% share of Zuffa.
Historical uses of capital. Break down what we're looking at here.
Well, I hinted a little bit about the distributions, but one of the prime uses during this period, they used that capital they raised for a variety of purposes. Okay, they used it to pay off principal and interest on their debt, to make dividend distributions to the original equity holders, to acquire other MMA organizations. They used, for the loans, they've spent like $56 million to buy Pride, just a few million during this period in 2006, they bought the WEC, they bought WFA, ended up buying Affliction, as we said, in 2009, the assets. So they're spending money on promotions, which is a lot, but the number one thing they used for all these billions of dollars they raised was distribution to the shareholders. And the distribution, we can actually see how much each shareholder got, right? So for this period, 2005 to 2016, this is distributions. This doesn't cover some of the other, like the salary the executives made or some other bonuses or some benefits they had with the company. This is just the distributions for being an equity shareholder. So during that period from 2005, when the tough boom took off, started that year, through end of 2016, after they sold to Endeavor, Lorenzo Fertitta and Frank Fertitta both got distributions. Well, if we round up, $538 million each. Dana White, the junior partner, during that period in distributions, got $115 million. And then the last member of the team, January, only joined at the end of 2009. They got $49 million in distributions. So between all those guys, those four members, including the three primary Zuffa members, they got paid $1.239 billion over that class period in distributions. So that's a tremendous amount of money, right? What's interesting too is that also that money, and we'll get into this a little bit later, probably we'll go and break it down more, that a lot of that money, that's more money than they had net income in that period. The company didn't make up that much money in profit to pay out distributions. Instead, they had to take on large amounts of debt and loans to pay themselves even more, as well as sell a portion of the company to get more money than they would have got just from the profits of the company.
Did they really take out loans to give themselves bonuses?
Yes, it was not bonuses, but distributions. As we mentioned earlier, they took out $350 million in 2007, and $250 million of that went to the three owners. In 2009, they took out an additional $100 million. $70 million of that loan went to the owners.
Let's get to section E3, the value to Zuffa equity holders.
Okay, this is kind of interesting because this gets to some other stuff. This is the equity of the company, the increased valuation of the company, right? And basically how they could take advantage of it by having the company. So the company they distributed not just the profits from the EBITDA to themselves, they also took out equity in the company through the sale of it, 10% to Flash, and I guess you could say through the loans, right? During that period. So they took out a lot of the wealth ahead of time. And so, people, this is one way to look at it. People always say that the one great thing about the UFC and Dana White brags about this all the time, that we are out here reinvesting in the sport. No one else is doing that, right? Well, theoretically, they're not reinvesting in the sport because they are spending more money than they were bringing in as earnings, right? As operating income. They were actually, instead of investing in the sport, they're investing in themselves by taking more cash out of the company than they was actually making. And so I find it somewhat hilarious, the whole concept that they're investing in the sport, right? That seems to be just a talking point on them. On top of that, on top of the benefits they got from taking money out for themselves, they got to use UFC to cover other costs. One of them is aviation expenses. They had five corporate jets, including 3 Gulfstream jets, a Bombardier Global Express jet, and a Boeing business jet. I don't know why that's important, but it's listed, so I'm going to read them off, right? They were spending, on average, $9 million per year during the period we have, 2005 to 2016, on the use of this corporate jet. But in preparing an analysis from Goldman Sachs, this was Zuffa hired them to do this. Goldman Sachs preparing analysis looked at it and said, really, aviation expenses should have been between about $1.5 million a year. So that means they were spending they're spending 5 times, 6 times as much as they should have for what their company needed for the use of the jet. So that implies that they were using that jet for their other businesses, perhaps Station Casino, or their personal use, and charging it to the UFC. So they were getting several $1 million of use of private jets on the company's dime, right? And so that's another benefit they had. On top of that, they had a management fee. Zuffa paid a management fee to the Fertittas or their management company through this period. The payments ranged anywhere from $500,000 to $2.7 million, and totaled about $11 million. So they were paying additional, besides what we said of them getting paid for the distributions, besides using the private jet, the Fertittas management company was also getting money from the UFC as a management fee. And these fees are separate from the salary and bonuses that were paid to Dana White as a president and Lorenzo Fertitta. So they got additional money as salaries and bonuses, but because those were part of the company, the general day-to-day operations, those are not included in here.
John, what about item 40, WME IMG sale proceeds?
On top of what we said before, on top of their salaries, on top of the use of the jet, on top of the fact that they got tons of money taken out and given them as distributions, over $1 billion, $1.2 billion combined for the 3 original owners. They sold to William Morris, IMG, now we call them Endeavor, back in 2016. Before that sale, they got a cash payment of $3.45 billion. They got a rollover of 19% equity valued at $325 million. And potential earnouts based on how the EBITDA does in 2017, totaling $250 million. I should note, this report was written in 2017. They ended up getting those payouts. They did get that additional $250 million in payouts. So you add all that stuff together, and the original equity holders, the Fertittas and Dana White, and January Capital, the United Arab Emirates company, they received in total, counting the sale and the distributions, $5.22 billion during their period that they owned the UFC from 2005 to 2016. Now, the expenses, what they lost, we didn't bring this up, but this report talks about it. Remember, they spent $2 million to buy the UFC, and then they put in another $36 million in investment, so $38 million total. And from that $38 million total of investment, they had ended up with $5.22 billion in return.
Yikes, that is insane. Okay, we have to move on to section E4, compensation and benefits paid to fighters. I'm going to go out on a limb and say that the fighters didn't get paid $5.2 billion.
No.
I'm going to go out on a limb and say they didn't get $1.2 billion.
The fighters, as you'd guess, since the plaintiffs are suing the UFC, claiming the fighters didn't get paid their fair share, that the fighters didn't get nearly as much as the owners. And, and one thing interesting to note, if you look through all the filings, the UFC doesn't contest this report. They asked for it to be redacted and thrown out, but they don't contest the accuracy of what's in this report and anything I've seen. So the numbers are probably accurate. What they contest is what value it has to the case, or does it mean anything for the case? And that's a different argument than does the numbers accurate. But according to this, the Zuffa paid its fighters primarily for fighting MMA events. And this report covers not just the UFC, it covers the WC fighters that fought under Zuffa and Strikeforce when they briefly were owned by the Zuffa as well. So from 2005 to 2016, on bout-related compensation, Zuffa contracted with 1,556 different fighters and to compete in the promotion. 1,177 during the class period is the number they have here. And they would get stuff like, the payments included their show money, the win bonuses for some of them, knockouts of the night bonus, discretionary, all that stuff. So during the class period, the lowest compensation paid was $750 a fight, and the median compensation for show during the class period was $14,000 per fight. Now I should note that $750 per fight, those were Strikeforce fighters when the UFC acquired them that were on the prelims. So that is not UFC fighters; those are Strikeforce guys. But that's the range, the basic range of the minimum of the show money and what the median is. So on average during the class period, most fighters walk into the cage with a $14,000 guaranteed show money, and then possibly the win if they can get it. And then if you look through, since you have the document in front of you, right, 46, you look through the next, there's a graph in there, and I'll have an article up and they'll have the graph and everything on it. So people can look at that as well. It goes through the class period and all the different types of payments fighters had, not individually, but an aggregate, all the different amount of payments they made to fighters during those periods, and then the total amounts as well. So we can see how much they got and how many fighters were paid in a year, how much their total show money was, how much their total win, how much their total performance, the discretionary performance bonuses were, how much their letters of agreement and signing bonuses were, pay-per-view amounts, all that stuff is here. So all those people that constantly say that we don't know the true numbers, that they hide stuff, I don't know what else they could be hiding, because it seems to be all here in the shown right here.
Let me ask you this.
Yes.
Show money. Tell me the number.
Okay, well, for show money, the total amount of show money paid out during the whole the class period, the whole period, I should say, was $250 million, basically. $250 million was the guaranteed amount to pay. And then on top of it, there's $82 million in win money. So you'd think it'd be twice as much, but the reason it's probably a lot lower is that there's, the top headliners often just have the show amount. And so that probably inflates the total amount for the show compared to the win. There also was a stat someone once had that they came up with, and I don't know if it's accurate because, we didn't have all the information, but they were saying that often fighters with the higher show win bonuses lose more than when they're against fighters with lower show win bonuses. So that could lower it as well. And then we have, they also paid during the whole period, the 10-year period we're looking at, 10, 11, $152 million in performance and discretionary bonuses, $174 million in letters of agreement signing bonuses. So that's the kind of the unreported stuff. And then $102 million in pay-per-view. So it's interesting. You add all that together, all those numbers together for this 10 to 11 year period, all the fighters combined made $761 million. Again, compared to the owners that got $5.22 billion. And interesting enough, you remember when Lorenzo Fertitta was in an interview with ESPN?
I do.
Okay. And during that interview, he boasted that the UFC fighters got paid about $250 million from the tough boom 2005 until that date of that interview, which is the end of 2010, beginning of 2011. According to Guy Davis, the fighters did get about $250 million, just under that, $246,624,000 paid total. The owners that time, remember, they're taking out loans to pay themselves. They're getting the earnings from distributions. The owners, the three owners, Fertitas and Dana White, they got paid just under $1 billion at that point. They've got 80% of that. If the fighters made $250 million, they got almost $1 billion. They got 80% of that total amount of revenue combined. Again, we talk about being an ATM machine. Now, listen, I know a lot of fans. There's a lot of people that yell at me on Twitter like, oh, they did everything to deserve this. But if you look at, like, let's say 2006, right? In 2006, the fighters were in total were paid about $26 million, $27 million. The Fertitas and Dana White together that year in 2006, 2007, their distributions were, I think, I got $63 million. So 3 to 4 times as much. This is before they even took out loans. Maybe they earned it because they put so much money into the company. But at the same time, do you think Dana White and the Fertitas did more than Chuck Liddell versus Randy Couture that year? And Tito Ortiz versus his 2 fights versus Shamrock, and then his fight versus Chuck Liddell, and Matt Hughes versus Hoist Gracie. And then we go on and on, all the people that were fighting in the Ultimate Fighter show, and Koscheck and Forrest Griffin and all the guys appearing. I just find it really hard to believe that they produce 4 times the value of all the fighters that year. On top of that, all the value the fighters produced that year, they only got paid that year, where after building up the promotion, the owners would get paid year after year because they're building up their wealth at the same time.
Item 48. UFC identity payments. What's that about?
Well, this is the identity payments that Nate Quarry was the lead plaintiff in that was dropped in the antitrust case. There's no class for that. So these payments have really no impact on the class action lawsuit, but they're, for our purposes here, they're kind of interesting to look at. It goes over the various payments from event sponsorship, video game sales, and merchandise sales that incorporate the name or likeness of UFC fighters. So those are the payments that fighters were paid for the UFC making a toy with them, or making some other product with them. Eventually, putting their likeness in a video game. Even though UFC, the contracts at the time said the UFC didn't have to pay them, but they would pay something. So you can look at each year. You can look at what fighters got from every type of thing, like in sponsorship, and also the other interesting thing is much fewer fighters took part in these identity payments. So like in 2009, 69 fighters got an identity payment out of all the fighters on the roster, of which only 7,000 got sponsorship from the UFC, a payment from the UFC over sponsorship. This was the pre-Reebok kit, but that's it. They also paid out $638,000 for the video games that year. So on average, those fighters almost got $10,000 on average each for the video game. We'll get to that in just a second, more about that. And then another $34,000 for merchandise. But the very next year in December 2011, the number of people got a payment is 74. And that year, the video game rights is down to nothing in 2011. So they paid them one year, they didn't pay them the next, right? So that you'll see that a lot. They'll pay when a new game comes out. They'll get a lump payment, but get nothing the next several years of the game sales. They don't get much in sponsorship. So the total amount that the fighters got during the whole period from these identity payments is about $20 million. So it's not a tremendous amount of money in the grand scheme of things. But I guess the interesting part is when you get the outfitter, if people remember how much fighters used to make from sponsorship, the total sponsorship payments fighters got during this period is only just over $5 million from the UFC sponsorship. And then their outfitting payment for the 2 years that they had at 2015-16 is $10 million. So that's $15 million total in kind of sponsorship, outfitting, wardrobe stuff that the fighters got. I'm pretty confident guess that the fighters in over 10, 11 years would have blown past that, considering how much they were getting from sponsors back then. Wow. If there was not things like the outfitter, the Reebok kit on the sponsor tax, stuff like that.
You can clearly see that the fighters took a hit when they brought in the uniform kids.
Oh yeah, especially the top guys that were getting paid $100,000 a fight or something like that.
Yeah.
You could really see that.
What about item 49, other value conferred by Zuffa to UFC fighters.
Well, this is things like the medicals. When Zuffa pays for a lot of the medical, licensing and stuff, they pay for insurance, injury insurance. They cover that. Other fighter costs, and some of them they couldn't figure out. But they pooled these together, and they figured out that fighter benefits, these additional costs that as independent contractors they should technically pay for themselves over the 11-year period. That the fighters gained $65 million in benefits from this. So it's not, this is one thing you can kind of compliment the UFC on, that they're covering these costs for the fighters. And this is money that the fighters have to pay for themselves normally, but still it's $65 million. Right. So it's, consider the grand scheme of how much they made. I think they would rather have the big cut of the money than have this covered for them.
Item 50, total direct payments and value conferred to fighters.
Well, this is all those items combined together. This is the bout class compensation, the identity class, and the other fighter benefits. When you add all those together during the class period and the pre-class period and stuff, you get the total period, that 11 years we're talking about. $846 million was paid to the fighters. For the class period, we're talking about $575 million was paid to the fighters. So you got to remember, for the class, and especially we should look at the bout class. Bout class got paid $515 million, and got to remember, their experts are claiming that the UFC owes them $811 million to $1.6 billion. So that's a big jump up from what they got.
Section E5, Zuffa's financial capacity to enhance compensation to fighters. What's that all about?
Well, this here is a graph. They have a graph on it. That's not a graph. Let me pronounce that correctly. They have a graph that shows it's pretty stark difference. One side's red, showing how much the fighters got total. The other side's blue, showing how much the owners got. Let me get, if you fan of Pac-Man, it looks a lot like Pac-Man taking a bite out of something, because the owner side is much, much bigger on the pie here. And what this is they're basically went through it, and we're talking about how, because of the UFC's margins they were making, how much revenue and earnings they were making, how much they could have saved by not spending so much on other stuff, because they could take out loans they want. They could have paid the fighters a lot more, basically what they're claiming here. Now, that's the heart of the case. Could the UFC pay them more? I think the numbers here show the UFC had the resources to pay him more. I mean, is there anybody out there still talking? Remember that old talking point? Oh, the UFC didn't have the money to pay the fighters.
Right.
I don't think anybody. This is almost dated, because it's hard to believe that there's anyone out there that still thinks that the UFC, if they really wanted to and not make as much as they did, could not have paid the fighters a lot more. So, but they have a nice graph to demonstrate just how much more the UFC could have paid them, and they're claiming that they could have probably paid the fighters 2-3 times as much and still be a viable company.
Approaching Section E6, Zuffa's accounting treatment of intangible assets, and I am noticing here in the little list that what you were talking about earlier with Affliction, with them just buying up the remaining rights after they folded. I notice here that in their list of companies acquired, Affliction is not there. Is that why?
Yeah, that's basically why, because they didn't really buy the I'm guessing that's why they didn't buy the company as much as they bought the assets and stuff. So, but actually the primary reason is because they didn't list Affliction as an asset that they had amortized. So it was not a purchase on the books. They bought it, but it was not something they were claiming, I guess, as an asset for the company. If that makes sense.
All right.
So this is the part where we talk too about, on this section, we talk about the World Fighting Alliance, right, the reason they bought it. You'll notice too that on some of them, there's a lot of non-compete agreements seem to be very important to the purchase, like World Fighting Alliance. There's a purchase price, and then there's an equal amount, $3.2 million in non-competes. For Pride, and they have a note and another document about this. They bought Pride for $56 million, but they had another $9 million in non-compete. It was very, very important, apparently, to them to keep Sakabara from getting back into MMA, and that's what the non-compete was. And again, that's a big part of the case, is that they paid him $9 million. They paid Scott Coker money. They paid these key people that they thought were potential rivals a large amount of money to keep them out of the business for a while.
All right. And then we get to section F, the conclusion.
This is obviously coming from the plaintiffs. This is obviously going to be biased in their opinion, right? Because they paid for it. But their conclusion is, from 2005 to 2016, and at all times during the class period, Zuffa was a profitable company with favorable operating margins and a substantial ability to produce cash. Its operational success made it an attractive target for both the lending and investing community. The original equity holders consistently adapted a very aggressive dividend policy, which effectively swept the company's cash flow, and in some instances, its net loan proceeds to them. The stark contrast between the value original equity holders elected to confer to themselves and the total compensation paid to the fighters establishes that Zuffa had the capacity to pay its fighters substantially more than the actual amounts paid. Oof. Now, again, it's going to be biased, but it is kind of hard to argue with that.
Yeah, especially after looking at all the graphs and charts. It's in black and white for us.
It doesn't mean that they're going to win the suit. That's a whole different thing. But when you look at it, and people talk to UFC, they couldn't pay the fighters more and stuff like that. That's patently false. They could easily afford to pay the fighters a lot more. The question and the lawsuit going when they eventually get to trial is, did the UFC violate the Sherman Act and break laws by not in a way that made them that they could suppress fighter pay? That'll be the question. But in this document, which it comes all the data comes from the UFC. There's tons of graphs further down we're not going to get into because there's just an endless amount of graphs and charts about revenue generated and what was paid for what. It does show that the gist of it is correct, that the UFC owners they had an ATM and they took out a ton of money, and they could have easily paid the fighters a lot more if they wanted to.
And that's basically going to wrap us up for this episode. It's a lot to chew on, we know, which is why we try to lay this out down to its atoms. John, what do you got coming up this week?
I don't know about this week. I'm not going to be on If the Shoe Fits. So, everybody give Eugene hell and Alexi hell for me, not being able to make it. We've got, besides this, I've got an article that goes with this that'll cover the same document. This is a good handy piece you can listen to, and then you can look through the article. This should hopefully help you understand it better. Maybe it won't. I don't know. We have a couple other articles in the future that are going to cover there's just so much stuff that's going to the antitrust lawsuit. I don't know what. I got to write a couple things on it, but I don't know what, because we just had 143 exhibits dumped on us last week. Covering a lot of stuff that, never thought would see the light of day for a while. So
those emails, my goodness.
Yeah, there's the emails. We have text messages. We have, I don't think I've posted the text messages yet. We have other documents. We have other reports that cover this stuff. Just an endless amount of material, plethora of material to work with. So I might have another article this week. I actually have an article about fighter pay that's almost done, but I've been swept up by the new exhibits. So we'll see when that gets out. So I guess an answer, I don't know what the hell I got coming out this week.
Well, I know what I have coming up this week, and that is poring over more documents with you, because one thing you guys can count on, it is that we are going to come back with the next episode with brand new information for you guys. So on that note, we are going to wrap up the show. We would love it if you would subscribe, because that helps us be able to spend the time to put these things together for you guys to listen to.
Who are the moochers not subscribing? Who are the lowlifes that are listening to this without subscribing? That's unacceptable,
Yeah, how dare you? But anyways, do me a favor though. Follow this guy on Twitter. He is at HeyNotTheFace. His messages, his direct messages are open. So if you have a question, a comment, a suggestion for a future show, anything at all, please hit him up. I am Crooklyn MMA on Twitter. My direct messages are open as well for the exact same thing. Both of our emails are open for you guys to drop us Questions, comments, suggestions as well. John is, you guessed it, heynottheface@gmail.com. I am Crooklyn949@gmail.com. And that about wraps us up. So y'all know the drill. Until next time, please stay safe.
Ow! Ow! Not the face! Ooh! Ooh! Okay, the face!